Hello and welcome to Welcome Home Radio. The waters in the mortgage industry can be pretty muddy, whether it's investing, leasing, renting, home insurance, or myths and misconceptions. Welcome Home Radio has the answers for you, the consumer. And now, to help you make the right home buying decision for you and your family, here are your hosts.
And welcome to Welcome Home Radio, where real estate lending and learning come together. This is your mortgage market update for March 17th. Stocks started out today unchanged, and mortgage bonds are sharply lower this morning. Home starts were down 10% in February and are down 9% year over year. And one of the most important statistics we can follow in our industry is single family starts, which are down 9% month over month and very flat for the year. A reason for the decline is likely all the bad weather that has taken place across the United States. Permits, which measure future construction, were down 11% and are up 17% year over year. Single family permits were down 10% last month and are up 15% year over year. So housing units that are authorized but not year started, in 36% year over year. So yesterday, the housing market index, which measures builder confidence, dropped 2 points in March to an 82. Now, an 82, which is much larger than a 56, which signals expansion, we're way above that level. So expansion is still expected, but we have declined slightly. The reason for the drop is the cost of lumber. It's costing roughly $24,000 extra to build a new home. Current sales have decreased, but expectations increased, and traffic remained very strong, even during this record low inventory and rising rates. Not too long ago, traffic was below 50, so still moving in the new direction of new construction. The MBA released their application data for the last week. Overall volume decreased 2%, purchases were up 2%, and refis are down 4%. Now, later today, the Fed chairman will release their statement, which will be followed by a press conference and the Fed chairman, Jerome Powell. While it's expected to announce they will do more buying and remain unchanged to their current policy. If this is the case, the bond market may be in for a disappointment and bonds could sell off even further. And in speaking of the Fed, do you know exactly what they do? What is their mission? How does that impact the bond market, rates, home mortgages, gross national product? Well, we're very, very excited today to have with us Mr. Bill Shaffer, 34 years retired from the Federal Reserve. Bill, thank you so much for taking your time while you're on vacation to visit with us today.
My pleasure. Thanks for having me.
Well, we're thrilled to have you. And of course, Alan with Fathom Realty is here with us as well. So excited about today's conversation because I don't think a lot of people understand, Bill, what is the Fed's mission and why is that important to us? Could you help us, our listening audience, understand that?
Yeah, it might take a few minutes just discuss the makeup of the Fed. It might serve us later on in conversation.
Sure.
As you know, the Federal Reserve, there's a board of governors resides in Washington, D.C. There's 7 board members, all appointed by the president and confirmed by the Senate. With the exception of the chair and vice chairs, they're appointed for 14 years and they cannot be reelected, or cannot be reappointed, I should say. The chair, Jerome Powell, as you mentioned earlier, and the vice chairs are appointed for 4-year terms, and they can be reappointed by the president, confirmed by Senate. But at the end of the day, that's where the administration and the federal government's influence on the Federal Reserve ends, is the appointments of the board. For obvious reasons. You don't want the president of the United States telling Jerome Powell to lower interest rates just so they can get reelected. It wouldn't be good for the economy. It might be good for his hers or his reelection bid, but not for the economy as a whole. So there's the Federal Reserve System, and that's made up of 12 districts across the United States. Just so happens in Dallas, who's one of the the home of one of the districts, the 11th district, and there's 12 across the United States, and then branch offices at each of the districts. Like in Dallas, we have San Antonio, El Paso, and Houston have Federal Reserve banks, and they're branch offices of the Dallas. Each Federal Reserve bank, whether it's a branch or a head office, has a board of directors, just like any normal business, corporate business out there, and they're appointed and they serve on the board for a period of time. And there's a chairman of the board, just like any other corporation, pretty much. And the presidents of each of the Federal Reserve banks and the officers within the reserve banks report to the independent board of directors for each of the banks. President of Dallas now is Robert Kaplan, and I'm sure you guys probably either talked to him or heard about him, but he's the president of the Federal Reserve of Dallas, and he's been there about 6 years now, and I think he has about 4 more years before he has to retire. So the Federal Reserve System basically is responsible for running impacting the economy to the extent possible through various services and regulatory responsibilities that they have. For instance, we have a branch of the Federal Reserve System that's responsible for overseeing banks, making sure they're healthy and got enough liquidity to be able to conduct business on behalf of the consumers in the economy. There's payments systems. The Fed has one responsibility to make sure the payment systems are efficient and running as efficiently as possible. So in other words, make sure the ACH transactions we all know about, whether we pay our bills through ACH or get our paychecks deposited into our banks through ACH, that's a system that the Federal Reserve is responsible for maintaining and making sure it runs efficiently. And then there's transfers of funds between banks and financial institutions. The Feds play a role in that. Obviously, back in the day, we used to write paper checks. We don't do that much anymore, but Fed's responsible for making sure efficiently clearing those payments in the most efficient way possible. But those are kind of secondary responsibilities that are important to the economy. But when it comes to interest rates and mortgage rates and the like, that your audience is probably more interested in, is conducted through the Federal Open Market Committee. And it's the Federal Open Market Committee is made up of the seven board of governors I mentioned earlier. And then on a rotating basis, there are 4 presidents that rotate on that committee. They rotate every year. And then there's one president, Federal Reserve Bank of New York's president. He or she is a permanent member of the Federal Open Market Committee. The reason for that I'll get into in a little bit, why he or she is the permanent member and not rotating like with the other Reserve Bank presidents. So when we talk about how the Fed is conducting, or how are they managing or help manage the economy, if you will, there's really only a few tools in which the Fed has it at its disposal. But if you look at the charter of the Federal Reserve has basically 2 mandates when it comes to trying to influence interest rates. And one of them is stable pricing. In other words, their goal is to keep prices down so we don't have inflation taken off in the economy. And the other is full employment. So those are the 2 mandates that the Fed is always constantly looking at, trying to figure out how can we maintain whatever full employment is at the time and also manage inflation. They do that through their Federal Open Market Committee operations. And it's quite simply buying and selling whatever they choose to buy or sell. Historically, it's been government securities. They'll buy bonds, bills, and notes to the extent that they feel they need to manage the money supply. And that's how, at the end of the day, that's what it's all about. The Fed tries to manage the money supply that's out in the economy to help influence interest rates. You'll hear the Federal Reserve, and Powell may say it today, I don't know, but the Federal Reserve will come out with a statement and say, I got a dog here. My apologies. Miles, that's enough. The Federal Reserve will say they're targeting the Fed funds rate at maybe 25 basis points. That's where it's been for quite a while now. They can't specifically say that that's what the Fed funds rate is going to be because they don't. That's not in their mandate. What they can do is manage the money supply to the extent they can raise or lower interest rates based on how much money is out in the economy. So if the Fed wants to lower interest rates, they'll just throw more liquidity out into the market by buying securities. Here, since the financial crisis of 2008, 2009, prior to that was, like I said, mostly government securities they bought. Now they're into municipal bonds, corporate bonds, mortgage-backed securities. In essence, the Federal Reserve can buy buy and sell whatever they want to get money out into the economy. But typically, it's usually bonds that they target. So if they want to lower interest rates, they just push more money out into the economy. And they do that by buying bonds or any kind of security or any kind of asset, quite frankly, whatever they choose to purchase. They buy those assets, place them on the books of the Fed, and then the money obviously is released out into the economy, and that has an influence on interest rates. And that's their goal. They have two other tools in their toolbox other than trying to influence the Fed funds rate. One is the discount window. So banks at the end of the day have to settle their position. So there's some reserve requirements. That is, I think, basically zero now, but it used to be reserve requirements. The bank had to have a certain amount of cash in their vault or deposit at the Federal Reserve by the end of the day. And if they didn't meet those reserve requirements, they had to go out to the Fed funds market and purchase or borrow money. And that's where the Fed funds rate comes in. It's basically the rate that banks charge one another to purchase or to loan money to each other. And so the Fed also, they're the lender of last resort. So if the Fed wants to lower the discount window rate, it's not by chance that the Fed funds rate and the discount window rate is at 25 basis points today. Usually they're in lockstep with one another. So if a bank cannot go to the open market, the Fed funds market, purchase or to borrow money to settle their position at the end of the day, then they can come to the Fed. And the Fed will loan it to them, and they'll charge them an interest rate as well, which is right now same as the Fed funds rate, 25 basis points. And then there's one other tool that's rarely ever used. There's a reserve requirement. If the Fed wants to take money out of the economy to influence interest rates, then they raise the reserve requirements, which requires the banks to have more money either in their vault or deposited at the Fed. Or if they want to lower interest rates, they can lower the reserve requirements, which they've done here since the financial crisis. They've done a couple of times.
Bill,
so those are the tools
Bill,
that
yes. Could I stop you? I think that's very important what you just said. That last tool that they have, I don't think our listeners understand what that means. And what, if I could, in simple terms, and correct me where I'm wrong, okay?
Yep.
Is basically there is a percentage of dollars of depositors that they have at that bank that they have to have a percentage of money cash on hand at the bank. And exactly that could range anywhere from 5%, 10% to 20%. Is that correct?
That is absolutely correct.
And so our listeners need to understand every bank has those requirements. And like you're saying, they could raise that requirement so they keep cash from going out of the bank and they keep it liquid in formats there, or they go lower that amount so that it becomes more fluid in the market.
That's exactly right.
And see, I think a lot of people do not understand what happens at a bank. They think my deposits are there. And of course, banks use those deposits to go and invest in other things. They're making money on your money, per se, and that they have to maintain that level of status for banking. And the FDIC backing, could you explain that a little bit more about what does that really mean? Because some banks, some regional banks or community, they don't have the FDIC coding. And what does that mean to you as a depositor in that bank?
Yeah, FDIC, that's a separate from the Fed, as you well know, but it is an insurance company, if you will. You want to think of it that way. Member banks basically it's insurance policy. Banks pay a premium for the FDIC to guarantee those deposits they have. So there's a fee associated with it, and like now I think it's 250,000. I think is the limit. So if you are a member of the FDIC and you take out, you become depositors, or you and I as depositors at banks, our accounts are guaranteed up to $250,000. Anything over that, that's FDIC doesn't guarantee. So and sometimes in the past, we've had banks that failed, not members of the FDIC, and the depositors are left with nothing or very little of their deposits or have been recaptured when those banks fail. So it's by account, not by individuals. So if you have multiple accounts at multiple banks and they're all under 250,000, you can consider yourself pretty safe. But if you have accounts over 250, you're in jeopardy. But the bank would have to fail for you to lose your money, though.
Sure. I appreciate you taking time to explain that, because that's what people need to understand is what's going on. And you meant something. That tool is very rarely used, if I'm correct, but they can change that liquidity status by maintaining more funds at the bank level, that raising that. And that's important for people to understand.
Yeah, and the reason, well, it's for safety. It's part of a sound banking system to have deposits or cash ready on hand for people if they were to need it. But it's important for people to understand that banks are in the business of lending money. So they take our deposits and they turn right around and lend it out. Even at the end of the day, when banks are trying to settle their position, meet their reserve requirements, banks will lend money to other banks because $1 in their vault that they don't have lent out is money that they're not putting to work. So they'll lend them to each other, and that's where the federal funds market comes into play, and that's how the Fed really tries to influence interest rates. What some people think. The Fed has a direct influence on long-term rates, and that's not the case. The Fed they're only targeting overnight lending rates, and then it kind of rips down from there.
I think a key question coming in right now, and again, listeners, please put your questions, your comments up there if you'd like to ask any questions. We have Bill Shaffer here from the Federal Reserve, 34 years experience. We're just so excited. Help me understand, who owns the Fed? Who owns the Federal Reserve? I mean, there's got to be an entity above. Who is that?
The Fed is owned by the member banks. I mean, member banks are literally own shares of the Federal Reserve. So it's not one area.
It's not a federal entity, is what I'm trying to get to.
It is not.
It's not a federal government entity.
That's correct. We do not get any appropriations from the federal government. We don't. The federal government doesn't fund its operations. In fact, we're a big moneymaker for the federal government. We, as a Fed, over the years, I think the last time I worked at the Fed, we turned over $75 billion back to the Treasury in 2016. We make money by charging for our services. We also make money through most of our money, almost all of our money, really, through federal open market operations, buying and selling securities or bonds or mortgage-backed securities, whatever we're in the market of buying and selling. We make money off of those things, just like an investor does. And so anything in excess of our operating expense, we turn over to the Treasury every year.
Wow.
Yeah.
I just think it's important that a lot of our listeners, I don't think they know who really manages. And like you said, the president appoints certain people and the Senate approves, but yet it is a separate non-government entity by itself.
The word federal is what really screws up people. When you're talking to the average person on the street, they hear federal and they think federal government, and you can flat out argue with somebody.
Yeah, you can.
The federal government does not run the Fed.
No, they don't.
Well,
we are not and we are not we are not government employees. We pay Social Security like everyone else. We have our own pension, our own health benefits. None of it's funded by the federal government, controlled by it. So it's a unique animal. We call ourselves quasi-government because there's influence, because the board of governors are appointed by the president, confirmed by the Senate. So there's some influence there, but there's only at the appointment stage. But again, Congress can change the Federal Reserve Act whenever they want and you do away with it of us if they choose to. But so far, so good.
Now, one of the things that I found amazing that I did not know until I bumped into a few folks, talk about money supply. Evidently, we have one of the largest burn centers in Fort Worth for you guys that get rid of, the single dollar bills and that sort of thing, and taking some things off the market, putting new bills on the market. Tell us that function that you perform.
Now, just to be right up front, Federal Reserve does not, even though it says Federal Reserve note dollars on our currency, we do not print or mint a currency or coin. We don't mint coin or print currency. We distribute. Our sole job is to distribute the currency that's produced by the Department of Bureau and Engraving. So, but we manage it because that's part of us managing the money supply. Currency is not as big of a part of the money supply as it used to be in the day, but it's still a significant amount of money that's out there in circulation. So we manage the money supply. That's how we influence interest rates. So if we want the overnight Fed funds rate to be 25 basis points, if that's our goal, if that's our target, then we buy enough securities to put enough increase in M1 or M3, I guess in this case, money supply, to a point where that interest rates start to drop. Because supply and demand, just like any economy, supply and demand matters. So if there's more money out there, banks have a tendency to lower their rates and drop those interest rates. So because they're still out there competing with one another. So if a bank has excess money, if you will, use the word money, then they can't find a borrower out there, a borrow out there, they'll raise their rates. If there's so much money out there and everybody's competing, at the bank, that's how the Fed manages the interest rate, is to manage the money supply that's out in the economy. And it's not just currency. It's all forms of what makes up the money supply.
Does that include the new crypto coin or Bitcoin and that sort of thing that's coming along, or do you all play in that realm at all?
The Fed is getting more and more interested in cryptos. And it's obvious because there's more and more of cryptocurrency coming online. When I left the Fed in 2016, it was just a discussion amongst the board of directors, and it really wasn't something. There wasn't enough cryptocurrency out there that really moved the needle when it comes to money supply. Still, I think that's still the case. But the Fed is definitely more interested, because I just read today Morgan Stanley is offering Bitcoin through their banks now. So really? We're seeing more fun.
What does this do to our economy when we start talking? Because now we don't have the translation of euro to dollar. We're going to deal with cryptocurrency, and that's standardized across the world. Is that correct?
Yeah. Well,
a simple way to look at it.
Yeah, the Fed can, right now, the Fed doesn't have a role in managing currencies, cryptocurrencies that are out there. That's one of the things that the Fed is looking into, and have been quite some time, actually, ever since Bitcoin hit the markets. But because the Fed manages short-term Fed funds rate through manipulation of the money supply. If they got this currency out there that they don't have any control over, if you will, cryptocurrency, that makes their role a little harder. If the overall dollar value of the cryptocurrencies start to become significant, Now, I know Bitcoin, I think, is getting close to $1 trillion of it out there, or something like that. It's sneaking up on $1 trillion. That gets to a point where the Fed starts paying attention to what's out there in the currency world.
Well, MasterCard has endorsed the whole Bitcoin thing, and of course Tesla is all in. So there's some pretty big outfits that are jumping on the bandwagon here, and I guess you could say it's off and running, but yet you read Berkshire Hathaway, they're not all excited about it still.
No, I know. It's a mixed bag out there about crypto. Really is.
One of the things, since the formation was in 1913 for the Federal Reserve Act, is that correct?
Yeah, we basically came online in 1914, but yes, that's when the act was signed. Yep.
So when did we come off the monetary gold standard? Was that about the same time?
No, that was in the Nixon administration. 72, I want to say. I don't know exactly when. But yeah, I believe it was in the Nixon administration when we came off the gold standard.
So what does that do? What does that mean for the dumb Texas boy that I am? Does that concern me that we're not on a gold standard now? The backing of our dollar is not there, or what does that mean?
Well, back in the day when we were on the gold standard, as you well know, we backed our currency backed it up by gold. Today, now it's solely and purely the borrowing faith the public has in the United States government. So it's just backed by it's just backed by there's nothing backs that currency up other than the ability of the government to borrow money. Basically, that's it.
Or to BS us, one of the two.
Or one of the other, or both. Yeah, there's nothing other than the good faith of the federal government. That's the only thing backs our currency.
Now, denominations of currency, how does that come around? Does that become something part of what the Treasury prints? Do they change denominations for you, or do you have a recommendation from the Fed to do that? I mean, how does that all work? Because we see more and more coinage being taken off the street, or more coins going into dollar format as opposed to dollar bills. And I just didn't know if you had an input into that.
They do. Obviously, the Fed is responsible for distributing currency and coin. So therefore, obviously, we have to tell the Treasury how much we need, how much are consumers out there in the market demanding as far as currency. As far as the currency and coin, I know there's been a push by the Treasury for years and years, and so far every one of them has been unsuccessful to try to replace the dollar bill with a coin, because the dollar bill I remember what it gets destroyed. It gets worn out so quickly.
Like 7 to 9 months or something like that.
Yeah. And then the $100 bills will last maybe a couple of years.
Yeah.
So if they could cut their costs by turning those paper dollars into coin dollars, then that helps the overall cost of printing and minting coins in theory. But they've tried, as you guys probably remember, everyone on the call or the show probably remembers, a lot of times they were trying to get those dollar coins, and us people out there in the market said, no, I'm not going to walk around with a bunch of coins in my pocket. I'd rather have a dollar bill. So we've pushed back and successfully pushed back as consumers on those attempts so far.
Well, our government doesn't seem to have any problem printing money anyway. So, I mean, I guess
it's literally or directly or indirectly. That's correct. Well, that's a scary thing when we start throwing around trillions of dollars, just like it's nothing. It's amazing.
Oh, now I have to ask this just because I'm very intrigued by this. And you said we're at 25 basis points right now. I have read and heard where mortgages are being done in other countries where people are actually, their country's paying them. They're getting points for doing a mortgage because of the flat rate or the bond rate being lower than 100%. Or do you ever see us going to a 0 points? I mean, at any point?
There's been talk, and even within the Federal Reserve, back when I was still working at the bank, about will we ever get to zero or even get to negative interest rates like
Yeah.
Japan and some other countries have gone to, and some of
I
the
think
European Union.
Norway and Sweden are in that realm right
Yeah.
now. They're at negative.
Yeah. I don't think the Fed's ever, this obviously I'm not privy to discussions during the Federal Open Market Committee operations. That's not my area of responsibility or expertise. But I know there's been discussion about will we ever have to get to zero to stimulate the economy? So far, we have not had to do that. The Fed's done a pretty good job of, in my opinion, of being able to provide the liquidity out in the market necessary for businesses to grow and the economy to work efficiently. Could there be a day that no longer those tools that the Fed uses today will no longer be effective and we will have to reduce to zero? Maybe. I don't know. We're at 25 basis points. I didn't think we'd ever get there in my lifetime.
Yeah.
So who knows?
Well, I mean, you've seen with the shutdown. I mean, you probably have a better feel on what's happening with the gross national product of America just through this last year of 2020 and a large quantity of states shutting down businesses and small business. It seems like what I've recently read is we've lost in excess of 7,800 small businesses that will never come back.
Right.
And
you can go around the corner and see one probably.
Probably.
Yeah.
And I just see that if we're going to stimulate our economy, we cannot depend on big box companies. We depend on mom and pop. We depend on the small business owner. That's who employs the majority of America, if I'm not mistaken.
That's right.
And how we're going to get moving forward is we've got to encourage these small business owners to take that risk again. Is that right? Would you agree? Or
I agree. And now there's thinking out there that I've read recently, the reason the bond markets rates have gone up here recently anyway, is there's this fear of the economy is going to overheat once we open up the economy back to pre-2019 levels. And it's going to be a fair amount of inflation that's going to come with it. Yeah. Personally, I think that's going to be if we do see a spike in inflation, I personally think it's just temporary. Once we get back to normal and businesses, like you said, come back online and we start getting back to pre-2019 activities as far as business goes. I don't know. We'll see. We'll see what happens. But it's going to be interesting to see how the small business men and women respond coming out of this pandemic. It's going to be interesting. I mean, some people are throwing up their hands and saying, that's it. I'm out. I'm not going. That's too risky for me. I can't control my own destiny when the government shuts me down when they choose to.
On a whim, yeah.
On a whim, yeah.
What do you see happening with insurance companies right now? Because not just because of, let's say, snowvid here in Texas, major ice storms and so forth, but I'm also talking about continued vandalism in certain portions of the country, continued loss of businesses, and then all of a sudden you're going to see large buildings being not manned because, hey, my employees can work from home. I don't need this real estate anymore. New York and other large metropolitan areas are starting to see a limited. What are insurance companies going to be pending on? Because to me, they have a huge potential concern in the near future.
I would agree. I'm not an expert. Don't know a heck of a lot about the inner workings of insurance, especially insurance amongst businesses. But I would think that they're concerned. I would think. I don't know how these businesses are going to get back online. I got some personal friends that shut their businesses down because they just couldn't stay afloat during this pandemic. They just couldn't do it.
Yeah, it's hard. One of the other questions I wanted to get to, and I'm sure you're more knowledgeable than me on this, is back again last year, 2020, we opened up the whole whirlwind of forbearance, and we have an excess of almost 4 million homeowners in forbearance. And
Yep.
as you historically you look at this, 89.7% of those people will never come out of forbearance because they did not understand that it's not a delay. You have to pay that once it comes calling. What do you see happening to the market? Do you see a large inventory of homes coming back on the market here through this forbearance and foreclosing of homes?
Well, logically, yes, that makes sense. I mean, these are deferrals, if you will. You're still going to pay. You're going to have to still settle up with your lender at some point. And so people get themselves, it depends on how quickly the economy comes back and how quickly people can get back to working and being able to provide for their families and be able to service those mortgages. But I would say a good number of them are going to find themselves upside down to a point where they just are not going to be able to get back to a healthy position with their lenders. And they're going to have to, we'll start seeing some foreclosures on homes, I believe. That's the way I think anyway.
That's logical. That's logical that more homes will come on the market that way.
Yeah.
We've not seen anything like this before in the United States, though, with the pandemic, the way it is, at least in my lifetime. You've got a lot of factors here. And so I think there are a lot of people in trouble, but I think there's also a lot of, I don't know, extra forgiveness going on. I don't think that's a technical term, but delay, like Bill said, how fast can people get back on their feet? Remember, banks don't want to be in the housing business. They don't want to be.
No, they don't. And I totally agree with that. But I also understand they've got a business to run. And if they've got somebody that is not paid in the last 12 months, it's come due. How much longer grace can take place? I just don't see it, especially with interest rates, numbers, all of that coming. So I just want to make people aware of it. Again, historically, 89% of the folks never come out of forbearance anyway. And I don't think they understand it very well. I don't think, it was easy to go into. They saw a fast buck
into it. They don't.
And it's a poor education process. I see that as I think somewhere late summer, early fall, that's going to be a major uptick in inventory available in the market. Now, Bill, I've got to ask this question. I'm sorry?
We can't get any less inventory. Trust me.
As the realtor cries. Bill, pardon me. Bill, what do our listeners not even know what to ask? What do you think is the most important thing you could tell our listeners about the Fed, what they do, how they impact? What is the thing that nobody knows about, or maybe there's something that they should know about distinctly? Please share with us, because again, we could probably talk another 2 hours and not cover everything that the Fed impacts, talks about, or has a say in. So please help us there.
Yeah, I think I hit on some of it that I think is important, or I would maybe say that people don't really understand about the Fed, but the structure and what the real purpose of the Fed is. And again, we got two mandates, and that's stable pricing. In other words, keep inflation in check, and then full employment. And sometimes those two mandates conflict with one another. Mm-hmm. And there has been in times in the past where inflation may take off, but then and because of inflation, jobs are lost and unemployment goes up. And the Fed sometimes have to do a balancing act between those two mandates. I will say they lean more towards keeping the inflation in check than the other, because they feel if inflation's kept in check, there'll be more economic activity, which generates more jobs and so on and so forth. So,
also you have to have people willing to work. There's some people that are just never going to work if they can figure out a way not to.
I agree. And now we're giving tax credits to kids that are. Yeah, I don't want to go there.
Yeah.
It's like guaranteed income is what we're in. We're in the world of guaranteed income.
I was looking, I was trying to read up a little bit about the Fed, and of course, you and I have known each other a long time. We've talked about it on and off, but the target for the Fed is, from what I can read, has been since 2012, roughly 2% inflation or less.
Yes.
Okay. And then I read where the Fed chair in San Francisco feels like, there's no unwanted inflation coming anytime soon. And then I read where other economists think there should be at least the right to worry. So how does a average person, consumer, where do you go there? I mean, is the Fed overconfident sometimes? Is that possible?
Well, the Fed looks at all. They got thousands of economists that work at each of the Federal Reserve banks, and also at the Board of Governors. They have economists that look at every sector of the economy, whether it's energy, whether it's, you just name it. Look at real estate. In your case, there's economists at the Fed in Dallas that do nothing but look at the real estate influence on the economy, if you will. So everybody has an opinion, and they all different opinions.
Well, the reason I'm bringing it up is because, like you guys know, you hear average people, man, they'll say something they don't even know.
Right. Each president has a bunch of economists that works for he or she, that advises he or she when it comes to trying to conduct monetary policy through the Federal Open Market Committee. So he listens to, and each region is different. Like in Texas, we're a big energy producer, right? So energy is a big part of our economy. In other states, in other districts, it's not. It's something else. Like 12 districts, technology is pretty big there. So there's usually conflicting. I don't want to say conflicting, but there's different advisors, if you will, and the presidents come to the table with different thoughts on their own local economies. Back in the day, before we all were connected, each district, one district may be doing very well and another may be in a recession. Years ago, but it's not going to happen here anymore. But back in the day, so that's the reason there's such independence on all the districts, is that they bring a different perspective on what they see in their region. So if you hear one president, like the San Francisco Fed, doesn't think there's inflation coming down the pike, but then you maybe hear the Board of Governors say, well, we got to keep our eye on it because it may, we just don't know. Jerome Powell's been pretty clear. He doesn't see any lasting inflation coming down the pike, but he also makes a statement and follows it up with a caveat, but we'll keep our eye on it. And if we see any indication, then we'll have to respond accordingly. But I think we're a ways from 2%. They've been trying to get 2% inflation target. They set that years ago, and we haven't been there since the financial crisis almost.
And I have a question that the layperson will ask. The Federal Reserve's relationship with stock markets around the world, locally and around the world. How does a Fed chair, when they're appointed by presidents, how does all that work? I think a lot of people, like Blair said earlier, you can't just tell somebody to do this because of that. But yet the markets react on every decision the Federal Reserve makes.
Yep. Well, the market does react, and the Fed does pay attention to the markets. The only influence they have on the market, obviously, is whatever their stated objectives are going to be. For now, they're still out. The Fed's out there pumping more liquidity into the market, continuing to do that, which in turn stimulates business activities, which in turn means businesses are going to make more money and the stock prices are going to go up and so on and so forth. So that's how the Fed how the market reacts to the Fed. They don't try to influence stock market. The stock market reacts to what the Fed does. So if the Fed starts to pull back the money supply because they want to raise interest rates, well, the whole purpose of that is tamp down inflation. So if they raise interest rates, economic activity will start to slow, and businesses won't be producing as much, and so on and so forth. And that's kind of how it indirectly influences the stock market. if that makes sense.
It does. Yep. I mean, I get asked that all the time. I mean, just.
Yeah, a lot of people think the Fed has a direct role in the stock market, and we don't. They don't. It's not we anymore. I'm no longer working there.
So help our listeners understand prime rate to mortgage rate and why there's a difference, if there is a difference.
Well, there is a difference, but you don't hear. I don't hear, or I haven't for a long time. Prime rate used to be the rate. That's a rate that banks. That's their prime customers. Their high FICO score customers that they're willing to lend to their elite customers. The prime rate, as you guys know, you guys are in this business. But if the banks lower, when the Fed lowers their interest rates, banks have a tendency to lower their prime interest rate as well, and that's the whole purpose of doing it. So more people can afford to go buy loan or take out loans to buy houses, or whether it's to buy durable goods or remodel their home or whatever. That's the whole idea, is to get cheaper money out there so business activity is stimulated. And the same applies to the mortgage industry as well. If you drop an interest rate, you're the lender, you know this better than I, but there's once you drop the interest rates by 100 basis points, you bring more buyers into the real estate market. And that's the whole idea around influencing the interest rates, what the Fed tries to do.
Like Jerome Powell's going to talk today here in about another hour or so. How fast does those words transcend into action in the market? Do you normally see a 24-hour delay, 48, 7 days?
No, I've seen in the past immediate. I mean,
Right away.
While he's talking, the market starts to take off because they're anticipating. And he'll say something later on in his prepared remarks, and all of a sudden the market would drop back down. I mean, you see it almost immediately when the words come out of his mouth. The market has a tendency to react. Now today, I don't think today he's going to say anything he hasn't been saying over the last several.
Yeah, we're not expecting any change.
Yeah.
We're not expecting any nuance or crisis and or positive. I think it's going to maintain as is, but it's just amazing to me that he's got to watch every influx, every adjective, every adverb, what he's saying, because it does, as you say, impact, and that quickly. It's not a delay reaction. It is immediate. Yeah,
it is. And even, some it depends on which economist you speak to. The Fed, if they were to target lower rates or try to target higher rates, it still takes a good amount of time before whatever that action is ripples through the economy. It's not immediate, but the stock market almost responds immediately because they're always future looking. Stock market is looking to the future, not the present for the most part.
Well, and I think the stock market is played by a lot of short gains, not long-term looks, and they're looking for a reason to sell and or buy. I mean, it's amazing to me how their job goes. So. Yep. So what question are we not asking, Bill? What question do you think it would be infinite to be able to share an answer with?
Well, I think I hit on them. Everyone, and I'll hit on it as well. The Federal Reserve is not a government agency. It's just not. It's an independent organization by design to minimize the influence of the federal government on how the Federal Reserve conducts business. I think that's probably one of the more misunderstood things that are out there about the Federal Reserve. As I mentioned, the president can't tell the Fed what to do. You probably, a lot of people picked up on that during the administration. He wanted the interest rates to be dropped even further than what they were, and Powell just didn't do it. The Board of Governors didn't do it. Yeah, didn't have to.
Well, I know I had several people asking me about crypto, and we touched on that. I think that's a very interesting point. And you said, it's not going to touch their radar until it gets up into the multi-trillion dollars. They're barely hitting that trillion, but it is something, like you said, we'll keep on the radar and see where it goes. But this has been awesome, Bill. I thank you. And if we could reserve the right to ask you back sometime in the near future, we'd love to be able to do that.
Blair, I'd be glad to. Just let Al know or contact me yourself. I don't care which.
Will do.
it.
We have thoroughly enjoyed it. Again, find us on kvgimedia.com on Facebook and or on YouTube. Like and share us. If you have further questions, send us. And we just appreciate your time today. I'm Blair Thomas.
Thanks, Billy. I'm Alan Pace.
Bill, thank you so much for coming on. God bless. Everyone have a great week.
You as well. Thank you.